First Federal Reserve press conference is in the books for 2023 as the Fed raises the federal funds rate by only a quarter point. Let's go ahead, let's break down what happened today and how that's going to go ahead and apply to the real estate industry right here in the Treasure Valley right after this.
Today, the FOMC raised our policy interest rate by 25 basis points.
Well, welcome back, everybody. Mike Petras here with MPRE Residential, your local real estate expert right here to the Treasure Valley or greater Boise, Idaho area. And of course, if you're looking to buy, sell, or invest in real estate right here in the Treasure Valley, please feel free to reach out to me. My contact information can be located right below. And please don't forget to comment. Would love to hear your thoughts on what you think the Fed is going to do, how inflation is going to go, all of that coming up in the future. Very responsive to that. Would love to hear your thoughts. But please stay tuned towards the end of this video where I'm going to go ahead and break down what he said today and what we can kind of expect this to filter out into the real estate industry coming up right here in the Treasure Valley. So let's go ahead, let's dive into what he was saying and start breaking it down.
We continue to anticipate that ongoing increases will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Blah, 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 same old everything that we've heard before. Ongoing FFR increases, reductions in the balance sheet, growth in spending on the way down, and the labor market is still really tight, high. But now he's saying the data is starting to look encouraging, but it's still not good enough. And because of that, they're going to continue to put the screws down on the federal funds rate. But before we go any further, let's go ahead and let's talk about the federal funds rate and how it directly affects mortgage interest rates. Well, unfortunately, it doesn't, but it does indirectly relate to them. In a nutshell, and it's not to bore you with all sorts of technicalities, but generally as the federal funds rate does go up, confidence in the 10-year treasury note goes down and people generally sell that off. And when they sell off their 10-year treasuries, then we can expect the yields to go up. And the mortgage interest rates almost directly correlate with the mortgage yields. So as the yields go up, you can expect mortgage interest rates to go up with them. But the best general rule of thumb is to know that when inflation is on the rise, mortgage interest rates are going to be on the rise and vice versa. And what's the exciting thing right now? Inflation rates are on the way down. So with all this strong talk from the Fed, let's go ahead and let's start kind of punching in holes like the reporters did at the press conference today.
As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate.
Great start-off question, Mr. Reporter. And yes, we do know that mortgage interest rates have been coming down. And why? Because not only is inflation coming down on a month-to-month and a year-over-year basis according to the data, but the Fed is also loosening its monetary policies. And what I mean by this is the percentage raises on the federal funds rate. It has gone from 4 consecutive 3/4 point raises to a 0.5 point to a quarter point. And this is a direct reflection that the Fed's monetary policies, according to the federal funds rate, are working. This in turn is bringing back investors to reinvest in the 10-year Treasury, which is lowering the yield. And as the yield has been coming down, so are mortgage interest rates. However, the Fed has taken a hawkish stance in saying that just because of the good news doesn't mean that they're not going to continue the increases on the federal funds rate. And they're going to continue to raise it until they're comfortable with the inflation data results, which honestly, I think the reporter said a great thing, is that it's looking good. The Fed is basically being a chicken, which means that they could really almost kind of over-tighten this thing and result in the effects of a recession. Stay tuned to the end of this video and see how it's already starting to play itself out in the real estate markets.
Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So far, what we see is progress, but without any weakening in labor market conditions. Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
So key takeaways from this reporter. She, like I did in my last video, really kind of said that all seems to be looking good except for the labor markets. However, according to these last statistics, it looks like the labor markets are finally starting to be affected by where the federal funds rate stands right now. However, this is really the first of it, and this is going to have to be a data stat that gets watched. The Fed, however, in their economic summary earlier in the day, said that wage growth was still super high as compared to the pandemic, but it is, or pre-pandemic, but it is starting to head the other direction, and wage growth seems to be coming down, which is something that the Fed wants to see. But this is now the second reporter in a row that is calling that out. In essence, what Jerome Powell is saying is that he's happy that all this inflation data is starting to come on the way down and not affecting employment, but he's saying that it's still too early to tell, hence his really hawkish stance about asking and answering any questions regarding the SEP and what they're going to do with the federal funds rate projected towards the end of the year. And he basically defected this by saying that the supply chains have been fixed, which is great. Great that you're finally admitting that, Jerome. That is something that we definitely want to hear. But he was also deflecting and also saying that housing rents are still too high, and he still wants to see that go in the right direction. This is now the second reporter and the second time that Jerome has kind of deflected, more or less saying too early to tell, don't want to give you any answers on the SEP, whether or not we're going to pause on the federal funds rate, etc., which the more that I kind of take this one, sounds like they're going to continue to tighten and possibly over-tighten. If they over-tighten, that could result in the effects of a recession. And if that happens, then they're going to have to loosen their monetary policies by using other tools quickly in order to bring the U.S. economy back online, which is also good for mortgage interest rates in the end. The more I listen to what he's saying, though, basically saying, I don't know yet, too early to tell, but things are looking good. We'll get back to you.
Take a meeting off, for example, and then resume. You know, could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail.
Translation, now I'm being asked whether or not I'm going to put a pause on the federal funds rate increases that they've been doing. No, we're not going to do that yet, but...
Connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's, around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
But I'm going to hit you with all this random different stuff of sectors of this and that you probably don't understand. So that way I can go ahead and just confuse the ever-loving daylights out of you to let you know that we really don't have a plan here. Everything's kind of up in the air. We're totally confused ourselves, and we don't want to say anything to get your hopes up. In other words, we are being hit with good positive data, but we want to cover our butts.
Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And
But we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. No one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's That's a possible outcome.
Ruh-roh, Jerome. Now the reporters are smelling blood in the water. And now you're being insulted by a reporter smacking you with your own positive inflation data. You even go on to say that we can get inflation back down without really even affecting employment. But again, you just don't want to admit it. You're scared. You're hawkish. Totally obvious. So why not take some actual positive, credible feedback for your policies, the Fed's policies, that might actually be able to help out the markets as we go through? Answering that question is the million-dollar question. But for all of you thinking that unemployment is going to reach astronomical levels, the Fed is confident that this is not going to happen and they'll be able to bring down inflation. Given all this, can the Fed possibly come in for that elusive soft landing instead of resulting us and pushing us towards a recession from over-tightening? Yeah, it's a possibility, but it looks like from what I'm hearing, they might be too dumb to do so.
You know, so we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down. And Congress did what it did, and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, you know, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, you know, sending signals that we think that the game is won.
And there we go. You admit it. But Jerome, isn't this your job? Isn't that the job of the FMOC? Come on now. Just like you thought this inflation was transitory. If you would have dealt with it back then, we probably wouldn't be in the issue we are today. Lastly, let's go ahead and let's add this question for dexterity.
One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
Look, we understand, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy.
So in summary, all the excuses are now really gone. Ukraine, COVID, etc. Inflation numbers appear to be coming down and in a good pace. Of course, minus the labor markets, but that is now starting to change. Wages are coming down, goods have returned, now switching gears over to services, and mortgage interest rates are also coming down. In fact, they are now showing the most stability that they have in months. The stock markets are still volatile, and some of the corporations are not showing the profits that they once did, so this is really up to debate because that's really not good. However, mortgage applications are on the rise, and Americans are returning back to purchasing homes. The Treasure Valley data, and please watch Mikey's monthly market updates coming out next week, should very well be showing that pendings are going up, inventory is coming down, and that people are returning to buying right here in the Treasure Valley. Stabilization appears right around the corner in our market here in the greater Boise, Idaho area. So with all this, the Fed still seems determined to crank up the federal funds rate and put the screws down further instead of taking pauses and breaks in the rate hikes. However, if I was a betting man, and according to these numbers, I'd be almost willing to bet that they might start reversing their monetary policy towards the end of the year instead of keeping it all the way through. But as long as positive inflation numbers keep up, things will get better. Unless, of course, they dive into the federal funds rate and put the screws down too far. In that case, Jerome Powell did assure us in today's conference that if we did end up in a recession, that they have the tools to be able to go ahead and correct it. But considering that they considered it transitory, etc., I really kind of doubt this. And do I think that they've already put the screws down too far and that we've already kind of exceeded that? Well, if you look at the ISM numbers, they have now dipped into recession territory. It makes me nervous. And I honestly think that the soft landing is not going to be popping up in terms of the actual effects of a recession. But will this recession be as hard as some of the ones that we've seen in the past? Well, due to what he was kind of saying today, when it comes to employment, I really kind of don't see that popping up. But when it comes to mortgage interest rates and whether or not they come down versus a soft landing or a recession, honestly, it's a win-win either direction. Well, as always, thank you again very much, everybody, for taking the time out of your day to watch this video. And of course, if you are looking to buy, sell, or invest right here in the Treasure Valley, greater Boise, Idaho area, please feel free to reach out to me. My contact information is once again below. And please feel free to comment. I'd love to hear your comments. Love to hear what you got to say, what you think is going to happen here with inflation over the course of the year, what the Fed is going to do and be able to react. Very responsive to those. And I'm also able to answer any questions that you generally have about the Treasure Valley right down below too as well. Please give me a thumbs up and a like for the YouTube algorithm. Please subscribe. Also hit that notification bell. And if you are thinking about relocating right here to the Treasure Valley from out of state, please click in the description below and download my free relocation guide so that way you're in the know before you decide to make the move. Well, thanks again very much, everybody. I look forward to the day that we speak. I look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.